I guess that you could ask, why are prices not lower, considering all of the supply that we see coming out of the Middle East and this push for drill, baby, drill in the United States?
Thanks for having me, Alyssa, once again. Yeah, you know, it's funny, right? So we're getting a weaker dollar, we're getting slightly lower oil, potentially lower rates at some point, right? It's all going according to plan. I do think one of the issues that has been supporting oil has been the seasonal strength of the summer months. But as we go into the second half of the year, we are going to likely see lower prices, and that's because inventories are most likely to build outside of China. Remember, in the second quarter, we had a surplus, but 97% of those barrels were stored in Chinese strategic reserves. And can you blame them after all the volatility we've seen in the Middle East, Russia, Ukraine? So the Chinese are acutely aware of the geopolitics and the fact that they're the biggest oil importer in the world. So 12 million barrels a day. So they have a huge exposure, whether it's the Strait of Hormuz or Malacca. They still rely heavily on oil despite all the electric vehicles that they keep pushing into their market. So I think that's been part of the story. My sense is they'll keep building inventories, but they almost have 40% of all oil stocks globally at this point, crude oil stocks, that is, right? So I do think second half of the year, the surplus is going to be close to 200 million barrels. And eventually we're going to spill out from Chinese inventories into the Atlantic Basin, into the US and Europe. And that's what's going to allow prices to come off. How much are we going to come off will depend on how much OPEC Plus keeps pushing barrels out. Because we've seen the rig count in the US is already coming down, is down 15%. So my sense is that we'll see lower prices, but not necessarily prices crashing.
Given the geopolitics and given the supply-demand dynamics that you were just talking about, how divorced is the price of oil from an economic cycle that seems to hinge on a new industrial revolution that 10 years ago would have included a huge use of oil?
Yeah, this is a very, very good point. And when you think about the energy demand we're seeing today, it's in some places in the U.S. is astronomical. I mean, Texan power demand is up 5.5% year on year. I mean, you can barely find an emerging market that's growing at that pace, right? And this is like insane. So I think if you look at the next few months, the majority of the demand, and probably the next 2-3 years, the majority of the demand for energy is going to be still renewables, also natural gas, which is what makes us relatively constructive on Henry Hub, and even into the summer on TTF, European gas. But for oil, it's not going to touch it immediately. It's going to take a little longer. I'm not even sure, oil is a transportation fuel for the most part. So it's kind of left by the wayside in this AI revolution for more energy at this stage. Maybe later on it may not, but for now it is.
Can you talk about that later on point? What could it eventually look like?
Well, I mean, I think if you look 5 years out, the demand growth rates we're seeing for energy, they're going to be pretty hard to meet. And remember how we've evolved 2 years ago. The big tech companies were looking for clean sources of power. They're like, oh, we just want to use super clean power and then, renewables and this and that. And then they said, well, maybe renewables and nuclear. And now it's like renewables, nuclear, gas. Now it's like, oh, just give me any power you can find because we really need a lot of power. I mean, we need, so there's talks about building 10, 15 gigs of power in Pennsylvania. There's you have the eastern border is going to need a lot of power. Texas already, growing beyond belief, and even other parts of the U.S. where you have these data centers, Pacific Northwest, you're going to have a lot of growth. And then eventually Europe as well. And the U.S. has a capacity problem. The U.S. needs to build those power plants. Europe, because it's destroyed its energy consumption in the last couple of years as a result of Russia, Ukraine, actually it does have the capacity. So it's going to be an interesting balancing act in the next 2-3 years for power too.
Well, just on that point, we finally have a ban on Russian imports coming into effect for Europe. And Total Energies, one of the biggest energy players in Europe, was saying, look, we have a tightening diesel market because of this. Right. How played out is this? Is there going to be more stress and tension in the market and tightening of supplies as the ban really starts to come into force?
There could be, certainly. And you also have to ask yourself, okay, so there's this ban on secondary resale, because the issue is, of course, Europe doesn't want to buy diesel that has come from originally Russian crude oil, which, as we know, is going mostly into India, but also into China, right? So Europe's been buying oil from refiners that actually do purchase Russian crude, and that's been one of the issues. But Europe still purchases 15% of its gas directly from Russia, right? So that goes for Belgium and France and Spain and Italy. And does it make its way into Germany too? So Europe is trying to really cut its dependency on Russia, but it's a tough thing to do because, again, only 3 years ago, or 3.5 years ago, 50% of European energy, oil, gas, and coal, came from Russia. So they're trying to do it progressively. And in the process, it's not been helping European industry, but that's kind of, I guess, part of the price that Europe is ready to pay.
Francisco, before we let you go, I'd love a comment on gold, the solid gold, the solid oil that we've seen in terms of just how people are treating it. We've seen prices double since 2022 to more than $3,000 an ounce. And I just wonder how much higher you see it going as you hear an increasing amount of people point this out as the haven asset, as there are real questions around fiat currency.
Right. So we have to be clear. Just like we are bearish on oil and we're constructive on gas because of the power story, we are bullish on gold as well. We think gold is eventually going to get to around 4,000 over next per ounce over the next 12 months. Having said that, gold needs more investor demand. The story has been mainly a central bank story, and of course, there was a nice tour yesterday of the Fed building. We saw that, right? So. The pressure is on for the Fed to cut rates, and obviously people are going to question independence, and one of the beneficiaries of that questioning is going to be the gold market, right? So, to what extent this this pressure builds on the Fed, political pressure, I think that's what will ultimately trigger a higher price for gold. But remember, jewelry demand for gold is down 20% year on year, so. So the real beneficiaries year to date of the gold upside pressure have been the other metals, the other precious metals like silver and platinum and palladium. So gold is doing well. It's still picking up momentum, but it's already a $20+ trillion market, right? There's $20+ trillion worth of gold out there. Remember, U.S. Treasury is in the hand of the public. 20 trillion or so, right? In the U.S. public. Now you have the foreigners, which own another 9 trillion. But gold's gotten very big, and to get another leg up, you need lower rates. When this happens, and particularly if those lower rates come on the back of political pressure, I think gold will get another leg wind.